Hi, everybody. So I want to do one last problem together from chapter 4. And I hope, actually, that this is not a problem that I assigned to you. Yes, so we want to do problem number 16 on page 4-54. Okay, sorry, I had to pause there for just a second. I wanted to make absolute sure before I started talking that number 16 was not a problem that was assigned to you. So this problem is extremely complex, and I'm doing this for you just for your own entertainment, so that we can see just how complicated some of this IRS stuff can be. I don't expect you to know how to do a problem like this. Don't feel bad if you're totally confused and you're like, oh my God, this is just so crazy. You guys are going to do problem number 15 related to this particular learning objective in the book, and that is totally enough. This other stuff is for like a tax professional that deals with this stuff on a daily basis. And even if you want to be a tax person when you grow up, you're not going to go and start doing tax returns that have this sort of complexity to them. So just pay attention and be entertained. Okay, so problem number 16. So we have Rob. He operates a small plumbing supply business as a sole proprietor. Remember, a sole proprietor is a pass-through entity or a flow-through entity, which means the income just flows right through to the tax return of the individual taxpayer. There's not like a corporate tax return or anything like that. In 2018, the plumbing business has a gross business income of $421,000. They give us some information on his business expenses, the amount of wages he had, a long-term capital gain for his business. They tell us how much qualified business property he has. He's got a wife. She has $250,000 of wage income. I want whatever her job is. $250,000 is your job. That sounds cool. They jointly sold stocks in 2018 and have a long-term capital gain. They have no dependents. And then the standard deduction. That's a whole bunch of information. Oh my gosh. Okay, so let's see what we're supposed to do. The income threshold for qualified business income limitations starts at $315,000 for married filing jointly taxpayers. That's something that's important to remember. And I just want to not lose my place here. Okay, so let's do the first thing. The first thing says, what is Rob and Mary's taxable income before the qualified business income deduction? So let's calculate their taxable income. Taxable income. Okay, we're going to do a big old calculation. The plumbing business has gross business income of $421,000 and business expenses of $267,000. We're going to subtract those since they're expenses. Oh, I have too many things there. There we go. What do they tell us next? Including wages paid of $58,000. You're not going to do anything with the wages paid in this calculation because the wages paid are part of the business expenses. That's just a piece of information that we're going to have to use in Part C. The business sold some land that has been held for investment, generating a long-term capital gain of $15,000. That's part of the taxable income. Whoops. Okay. The business has $300,000 of qualified business property. That's not an income or an expense. That's just telling us the amount of the business's assets, so to speak, but following certain definitions. It's not part of taxable income, so it's just information that we're going to have to use later on for Part C. Rob's wife, Marie, has wage income of $250,000. Wage income is taxable income, of course. And then also they had that long-term capital gain of $13,000. That's certainly taxable. And they have no dependents, so they take the standard deduction, which for 2 people is $24,000. Okay. Their taxable income is $408,000. So that's the answer to part A. Part B, what is Rob and Marie's qualified business income? Their qualified business income is, we're going to perform a calculation here, their gross business income of $421,000 minus the business expenses of $267,000. $154,000. That's the answer to part B. So that is their qualified business income. We don't add anything in there about the business's capital gain because that is not part of the qualified business income. That's just going to be a capital gain. Okay, so now here's where it gets really exciting. Part C. Part C wants us to calculate Rob and Marie's qualified business income deduction. And this is super complex. So if we didn't have any sort of limitations that we had to pay attention to, like in number 15, you guys don't have a super high income taxpayer like we do here in number 16. So there's some limitations. So notice how in the problem they pointed out that the income threshold for qualified business income limitations starts at $315,000. So if we didn't have any sort of limitations that we had to worry about because they have taxable income that's above this threshold, normally their qualified business income deduction without any sort of limitation would be the $154,000 that we came up with just a minute ago times 20%. And that is $30,800. But that's not the answer. It's not that simple. So we have some limitations that we have to pay attention to. Okay, so there's a couple easy places to reference some of this stuff that I'm going to point out to you. Let me find the best place. Well, for this first one, it's just right in front of me, so I'm going to use this. So go to page 4-42 of your textbook where they give you some of this summary stuff. So down there for learning objective 4.10, it says that the qualified business income deduction may not exceed 20% of taxable income. Okay, so that's important to know. But their taxable income, remember we decided their taxable income is $408,000. Their taxable income exceeds the $315,000 threshold. That $315,000 threshold is mentioned right below that in 4-42, and it's also within that section of the chapter. So we need to do some extra stuff. So their taxable income exceeds that $315,000 for married filing joint taxpayers by $93,000. And $93,000 is their taxable income minus that $315,000. That's where I'm getting $93,000. Okay, so we have to do some extra stuff. So now the qualified business income deduction is subject to the wage limitation. And they talk about that also at the bottom of page 4-42. The qualified business income deduction is limited by the wage limitation or the wage and capital limitation, whichever is greater. Oh my gosh, this is so much work. But it's okay because we have nothing better to do. Okay, this is fun. Wage limitation, what are they talking about? Go to page 4-36 for the wage limitation, and then go down to, well, definitely read all of it, but I'm going to specifically reference when you get down to about halfway, well, kind of like the beginning of where the third paragraph would be. The wage limit is the greater of 50% of the allocable share of W-2 wages with respect to the business. So let's figure that out. Wage limitation. Oops. Hello. Wage limitation. Let's figure out what that is. They told us, remember how earlier they said this included wages paid of $58,000? Here's where we're going to use it. These are the wages that the company paid to their employees. And we're going to multiply that by, go back to page 4-36, 50%. So 50% equals 29,000. Okay. Then they told us that we have to perform another calculation, and then it says that it's going to be the greater of this number or the other number, which is going to be the wage and capital limit. So we get to do some more calculations. Now it's going to be wage and capital limit. So they say 25% of the allocable share of W-2 wages with respect to the business. So first, let's figure that out. 25%. Plus, then they say 2.5% of the unadjusted basis of all qualified business property. So 2.5% of the unadjusted basis of qualified business property. They told us right here, the business has $300,000 of qualified business property. So that's what goes there. What's the answer to that calculation? 22,000? Are you guys glad that I didn't assign this problem? Yay, that would be so mean. Okay, so it's supposed to be the greater of the two. The greater of the two is the wage limit of 29,000. So the excess qualified business income deduction is 1,800. How did I get that 1,800? Oh my gosh, where did that come from? Okay, so remember how back up here we calculated that 30,800? That was their, I'm going to add this to here. That was their qualified business, income deduction without limitation. So that's what it was without limitation. But we have these limitations. We just calculated that the limitation was going to be the greater of either this number or this number. This is the greater number. So there's an excess deduction. That excess, I need to move this up. Excess. Oh, that's okay right there. The excess is the 30,800 minus the 29,000. The excess is 1,800. Okay. Oh my gosh, we're not even done yet. Okay, because their taxable income exceeds the $315,000 by $93,000, then there's one more thing that we have to do. And I'm just trying to find... Okay, sorry, I had to stop and find what I want to reference for you. So now to figure out what we're going to be able to do with this excess, because their taxable income exceeds the $315,000 by $93,000. Remember, we calculated that right here. So now what we're going to do with that $18,000 is there's going to be a phase out of the excess. So the very first paragraph on page 4-38, you go down to line 1, 2, 3, 4, and it says, instead, the qualified business income deduction is subject to a phase out up to an excess of $100,000 for married filing jointly taxpayers. So their excess is already $93,000. After $100,000 of excess above that $315,000 limitation, then this excess that we're talking about right here would just completely go away. But they're going to be able to use just a little bit of it. So go down to the bottom of that paragraph now, where it says the excess amount is subject to a pro rata phase out based on the taxpayer's income over the threshold amount. So this isn't even really clear, I think, in the textbook, but we're going to multiply this by 93%. 93% is 93,000 divided by the $100,000 that I was just referencing just a minute ago. But it's super confusing in the textbook. So that's one reason why I didn't assign this problem to you, because it's so hard. Okay. So $1,674. So to get the answer to the problem, what is Rob and Marie's qualified business income deduction? We're going to take that $30,800 from before, which is right here, and then we're going to subtract their limitation, the $1,674, and that's going to give us a qualified business income deduction of $29,126. Oh my gosh, that was crazy. That's all I'm going to do for chapter 4. So I'm done. You guys are, again, not doing a problem like this. Don't feel like you should be able to do a problem like this. This is really, really complex. And I will talk to you guys again for chapter 5. Bye-bye.